Hello and welcome back to the Military Money Manual podcast. Today on the podcast, we're talking about how military service members can apply the Bogleheads investing philosophy or the Bogleheads investing principles to their investing strategy. Jamie, I'm excited to talk about this. I would describe myself as a Boglehead. I'm a big fan of Jack Bogle, the founder of Vanguard. I think he did some really good things for the average retail investor, and he's enabled a lot of people to become millionaires and pay extremely low fees. There's this idea of the Vanguard effect, where whenever Vanguard goes into a market and starts driving down the cost of investing, all the other fund managers have to follow them. And so you see it where as soon as they launch a fund into, let's just say, like international emerging markets, right? Whereas previously the fund fees might have been an average of 1%. Very soon after Vanguard enters that market, they start dropping rapidly. And when you have lower costs, that means you get to keep more of the return. So we're going to run through 10 principles of the Bogleheads investing philosophy today.
What I love about the Bogleheads philosophy is that anyone can use these principles and make it simple to invest successfully because it only takes a little bit of effort. And before Vanguard's popularity and Boglehead philosophy came online, most people needed a financial advisor to talk to them about how to invest. So that's one of the nice things, that this kind of opens it up to the masses, if you will, and makes it really easy for anyone to follow. A lot of the principles we'll talk about today are similar to the things you'll find in Spencer's book, The Military Money Manual, which is the practical guide for military investors pursuing financial freedom. So don't forget to check that out as well. But with that, Spencer, let's kick it off. What's the number one thing from Bogleheads that applies to military?
Okay, well, actually, Jamie, I'm just going to run through all 10. So they just want the high-level version. We'll just run through all 10. So number 1, develop a workable plan. Number 2, invest early and often. Number 3, never bear too much or too little risk. That's an interesting one. Number 4, diversify. Number 5, never try to time the market. Number 6, use index funds when possible. Number 7, keep costs low. Number 8, minimize taxes. Number 9, invest with simplicity. And number 10, stay the course. You'll also see, Jamie, a lot of my LADs, low cost, automated, diversified, and simple. My personal investing philosophy comes right out of the Bogleheads. Like, there's no new idea under the sun. If it ain't broke, don't fix it. So number 1, develop a workable plan. I think for most people, this doesn't even involve writing it down. I find it's useful to kind of write down and collect your thoughts. And especially if you have a partner or a spouse, you've been married, it might be good for you just to jot down like, hey, we're going to start putting 10% of my base pay into the TSP. And we're going to utilize a life cycle fund. And that's how we're going to invest for retirement. And your spouse might be like, I don't understand any of the words you just said, but I'm really curious to learn more about that to start having money conversations, military money conversations. So I know for myself, like we have an investment policy statement, and I'll post an example of that up on my website, militarymoneymanual.com. I mean, it sounds very fancy, but really it's just a collection of ideas that my wife and I have developed about investing. And, some of those things are like, when the market's down, we don't sell, right? Like we don't panic and sell. When the market's up, we maybe look at rebalancing if our asset allocation gets off a little bit. But I think it's important, for me at least, to have a written plan. I can refer back to it, especially when there's market turmoil. I know earlier this year, Jamie, I mean, it's easy to forget, but earlier in 2025, in April, the US stock market was down 19%? Like it just barely avoided a bear market. And now we're up like 16 or something percent. I checked the other day, from that low, if you had purchased, we're up 38% from that low. I mean, that's crazy. That's, if you'd put in $100,000 at that moment, you'd be sitting on almost $140,000. So I think it's important to develop a workable plan and then to stick to it, to stay the course, which references point number 10.
The nice thing about this is also it allows you to talk about the why of your investing and take away some of that decision fatigue or the emotional decision that sometimes come up when the market is really high or really low. So you set it when you're in unemotional, steady state, ground speed zero, if you will, like we say in our career field. And then when the stressors come, you see the media freaking out about the market one way or the other. You've already made up your mind that this is how we invest. Number 2, invest early and often. You mentioned LADs already, Spencer, the low cost automatic. Automation is your friend. So a very set it and forget it philosophy help avoid the decision fatigue I just mentioned, as well as for military investors, we have the TSP, which is about as automatic as it can be.
Yeah, absolutely. I mean, we're big fans of the TSP on the podcast. And, this is a great time of year if you're listening to this in early 2026, or at any time in the future, you could log into MyPay right now and you can change your allocation, hopefully increase it. And then that's one decision you have to make one time, right? Like you have to, and for some people, like logging into your MyPay account might be a bit of a pain in the butt because maybe you forgot your password or maybe your CAC's been locked out or whatever. But fight through that friction, get into MyPay and increase your allocation. So that might be if you're at 10%, you go to 11%. Or if you just had a time and grade or a promotion, then maybe you bump it up from 10% to 15%. And then every year thereafter, you're going to add another percent. But if you're only making that decision once, that's removing 100 future decisions. And that's just saving a lot of brain power, willpower. I was talking to a coach the other day who was talking about won't power. And in this case, like, people are struggling to save and they're like, I get to the end of the month and I just can't find any money. It's like, well, pay yourself first and start putting in money to the TSP automatically and invest early and often. And, I think for most people, it's not like you have a big chunk of change, although you might. I was talking to a lieutenant the other day who's like, I didn't know what to do for years. And so I have $50,000 sitting in my checking account. And that's like,
Nice.
First, yeah, it's like, congratulations. Like you can obviously save, like you're not living paycheck to paycheck, but let's get that money to work. The best time to invest is right now while you have decades of compounding interest ahead of you. So invest early and often. That's point number 2. Point number 3, never bear too much or too little risk. I see this most often, Jamie, when people are in their 20s or 30s, and thank goodness the TSP pivoted away from this, but it used to default to the G fund. So if you put any money into the thrift savings plan, it was automatically going into the G fund. And that's so painful because I've talked to people who retired after 20, 30, 40 years, and they look at their TSP and they're like, wow, I've got, $250,000 or $500,000 in there. And it's almost too painful to go back and say, if you had invested that in the C fund or the CNS fund, that would be probably 10 times that. That would probably be multiple millions of dollars. And that sucks. And so I'm really glad when the blended retirement system came out, now the default is a life cycle fund appropriate to your age. So if you were born in, how old are the kids now? 2005, let's say, plus 65 years or 60 years, you're looking at like a life cycle 2060 or life cycle 2070 fund, somewhere around there. And they even in 2025, they released the Life Cycle 2075 fund. So it's just going to keep going. It's the circle of life. And I love the life cycle funds of the TSP.
Yeah, because the risk is balanced for you, especially while you're trying to decide what to do. There's all kinds of rules of thumb out there, like your 100 minus your age is the percentage of equities versus the bonds and all of those things. But when you do the most applicable life cycle fund to your retirement year, not your I'm getting out of the Air Force or getting out of the Army or retiring from the Marines year, but your actual retirement age, 60 or so, 65, that TSP life cycle fund does the risk for you, which helps you out. The other thing it does for you is it also helps you diversify. Point number 4, diversification. Very easy in the TSP.
Yeah, there's 5 funds, right? The C, S, I, G, and F. And with the C and the S fund, you have total US market exposure. So you have 500 companies. The 500 largest companies in America are in the C fund, also known as the S&P 500. And then in the S fund, you have the other 2,000 companies that are publicly traded in America, the smaller companies that just aren't in the S&P 500. And so between those 2 funds, the C and the S fund, you can invest in every publicly traded company in America. So whenever I'm talking to kids and they're like, oh, I like to buy stocks and, I bought some Tesla and I bought some Microsoft and I bought some Amazon. I'm like, are you putting any money into your TSP? Oh, no, I don't like the TSP. You can't buy stocks there. I'm like, that's just not true. You can. You're just buying a little bit of every publicly traded company in America. And for most investors, that's going to be a pretty reasonable way to invest. Also, with the new I fund, it used to be not that great. Now the I fund is over 20 emerging markets, over 20 developed markets, and you get exposure to over 5,000 international companies. You get exposure to all the biggest markets in the world, except for China and Hong Kong. If you want exposure to that, you can do that in your Roth IRA or your taxable brokerage account with a fund like VXUS. That's the Vanguard Total International Stock Market Index Fund. But diversify. Yeah, don't put all your eggs in one basket. All you got to do is talk to anybody who invested in Enron or WorldCom or I'm trying to think of, Lehman Brothers during the 2008 global financial crisis, or I'm sure in a couple of years, if you talk to anybody who's investing in MicroStrategy, MSTR, which is a total Ponzi scheme and fraud, take a look at that. If you want to see a company to short sell, not investment advice, but check it out. Actually, that is investment advice. Go check it out. But yeah, diversify. I think that's critical for any successful investment idea. You don't want to put all your eggs in one basket. And I find that, when people are like, oh, throw it all in the C fund. Okay, that's great. You're investing in the 500 largest companies in America. That has been a great strategy for the last 50 years. In fact, that has been a great strategy for the last 100 years. I don't know if that's going to continue to be the best strategy going forward. And so when we talk about diversification, we're not just talking about diversification of what assets you're buying. It might even be diversification of countries. It might even be diversification of time horizons, right? Like you might be buying into the G fund and the F fund, and there's bonds in there that are maturing in 1 year and maturing in 7 years, but that's all captured inside the TSP. And so point number 4, diversify. Excellent point there, Jamie. Just a quick note from one of our sponsors, and then we'll be right back to the show.
It's no secret Spencer and I are both huge fans of the Thrift Saving Plan, the military's version of the 401k retirement plan. We've both been investing in the TSP for over 14 years and are thrilled to announce we've consolidated all the information you need to know into a new course called the Confident TSP Investing Course.
That's right. The course is a comprehensive guide to navigating the TSP, breaking it down to easy, bite-sized chunks that lay out the basics of the thrift savings plan, the funds available, and the investing strategies so you can build wealth while you serve.
We both know what it's like to be a beginner and to be overwhelmed with all the information that's out there about investing in the TSP. Head over to militarymoneymanual.com/TSP, Tango Sierra Papa, to find our simple breakdown of all you need to know. You get lifetime access, and we'll have a growing library of content. And one of my favorite parts about the course is that for every course we sell, we're going to be donating one to an E4 or below.
Yeah, I love that feature of the course, Jamie. So if you're an officer, an NCO, a senior NCO out there, and you purchase a course, first of all, thank you. And also know that you're helping a fellow service member, a sailor, a soldier, a Marine, an airman, a guardian, a Coast Guardsman, E4 or below, take one step closer to their financial success.
The link's in the show notes, or head over to militarymoneymanual.com/TSP, where you can sign up for the Confident TSP Investing course. Now, back to the show. Number 5, never try to time the market. So no matter what we're doing, just like we talked about with our workable plan and our investment philosophy in point number 1, we take the emotions out of it. We invest automatically. Like we said in point number 2, it can be really tempting to try to time it, but it's darn near impossible to time it perfectly because you have to be perfectly timed at both the high and the low, buying or selling respectively. And you have to get it right twice because you have to know when to sell and then when to rebuy, or when to sell and then to buy again. So very, very hard to time the market. Most people cannot do it correctly. And if you do it right this time, you're not going to do it right the next time. If you happen to get lucky twice in a row, you're definitely not going to get right the third time. It is impossible. Don't play that game.
Well, it's just like flipping a coin, right, Jamie? Like if you put 1,000 people together and have them all flip a coin, someone in that group is going to flip 8 heads in a row, right? And then everybody's going to want to go and talk to them and say, oh my gosh, how did you flip 8 heads in a row, right? And they're going to have this, I imagined the, flipping heads. I manifested it. I visualized it. No, it was just luck. And so you're going to find fund managers out there that have crushed it, that have a great performance. But if you look at the long-term track record of active managers, it sucks. 90% of them cannot beat the S&P 500, just an index fund, after fees over a 20-year time period. And it's the same for almost every other asset class. So never try to time the market. I tell you this, Jamie, I'll make a prediction right now. In the next 10 years, the U.S. stock market will drop 30%. There will be a 30% drop in the U.S. stock market. I will be right in the next 10 years. Mark this day. Guess what? I'm not doing anything about that because I have no idea when that drop is going to happen and how quick the rebound is going to be. There were so many people that as COVID was developing, they moved to cash. Wow, great foresight, a global pandemic. You sold your stocks, moved to cash. Guess when they bought back in? Not in March of 2020 when it was getting as bad as it was going to get. It's very difficult to know what the total market is going to do. There's a lot of players out there. And so time in the market is much more important than timing the market. And that brings us to point number 6, which is use index funds when possible. A Boglehead principle And thankfully for military service members, we have the thrift savings plan. You have 5 index funds in there. And if you don't know which one to pick, there's a life cycle fund for you, which is a target date retirement fund made up of index funds, the 5 index funds that are in the TSP. I think it's helpful sometimes, Jamie, we use these terms like index funds, and sometimes people don't understand what they mean. But basically what it is you have an index, right? So in this case, there's an index called the S&P 500, the Standard & Poor 500. And all they do is they look at the value of all the companies, the U.S. companies traded on U.S. market, the New York Stock Exchange and the NASDAQ. And they say, okay, take the share price, multiply them by the number of shares. That's the market capitalization. What are the 500 largest companies by market capitalization? And there are now companies that are worth trillions of dollars, thousands of billions of dollars. And the S&P 500 basically says, here are the 500 largest companies. The C fund looks at that list and says, great, Amazon makes up 1% of the market, so we're going to invest 1% into that. Apple makes up 1% of the market, so we're going to invest 1% into that. So you put in $100 into an index fund, and then the index fund manager splits your $100 across all of the companies or bonds that are inside that fund. That's what an index fund is. So, and we like them because you can go read the Little Book of Common Sense Investing by Jack Bogle. Fantastic. And he gets into the math of how the average return of all investors has to be the market return. And in fact, most retail investors underperform the average market return. So if you can just get the average market return, you're going to do better than all of your crypto bros and Robinhood day traders and options, the guy in the unit who's, selling calls or whatever. Yeah. You don't need any of that. You can keep it simple. You can keep costs low, which is actually point number 7.
One of the great things about the TSP is that it does have low costs, and you can find lower costs out there, including some free funds at Fidelity. But what we really want to stress to you is if you're paying 1% or 1.25 or sometimes more, it really kills your returns over the long run. And there's more posts on the militarymoneymanual.com about that and some graphs that demonstrate just how bad it is for your growth. But also remember, how is the person trying to sell you this fund making their money? It's probably commission based. If they're even an advisor, they can call themselves a financial advisor and not really be a financial advisor. They might be selling you insurance. Do they make commission by selling you a certain fund? Do they have a front load fee? Some funds have a 5% front load fee. So if you put in $100, 5% off the top, you only get $95 invested. And every time that you invest, it takes 5% off. So there's all kinds of fees out there. Pay attention to how the person trying to sell you something is making money, and actually read the documents that comes with what you're buying, especially if you're buying it from someone. Don't trust your cousin's friend in the strip mall in small town USA without truly understanding what you're getting into. Costs are very important, Spencer.
That's right. Yeah. So when we talk about, keeping costs low, thankfully the thrift savings plan under 10 basis points. So that's 0.1% cost for all of their funds. So thankfully for military service members, fees are extremely low at the thrift savings plan. And if you use any of the big 3 brokerages that we like on the podcast, Fidelity, Vanguard, Schwab, Fidelity, you can use their FZROX fund. It's 0% expense ratio. You can go online and figure out how they do that. But even the Vanguard funds, it's 0.03% expense ratio. So my rule of thumb, Jamie, once we're getting below a quarter expense ratio, now none of my funds have a quarter expense ratio on them, right? I think all my funds are under 10 basis points. But once you're under a quarter, we're really splitting hairs at that point. The goal, though, is to get away from, when you're paying like your fund manager 1%, or I've seen as high as like 1.5%, 2%. Then you're paying the expense ratio on the fund as well. There might be buy and sell, load fees. No, we just don't want to deal with any of that. There's some predatory companies out there that prey on the military. You can search for Military Money Manual Do Better to see one that I'm talking about. I'm not going to mention them on the podcast because they already sued me once. But yeah, there's some predatory companies out there that prey on military service members not understanding how expensive fees can get. So don't go with those guys. Go with Fidelity, Vanguard, Schwab, and make sure that you're maxing out your TSP.
All right, number 8 is to minimize taxes. So we like to talk in this podcast about Roth accounts. Remember, with Roth accounts, you're paying taxes on the money now, then investing it. So as it grows over the next 20, 30, 40 years or so or more, you've already paid tax on it. So Roth money is really good for the average military family, but you want to make sure you put assets in the right basket. For example, bonds go into retirement accounts because that's more tax advantage because you're not paying taxes on the income coming in from bonds if it's in a retirement account versus it being in a brokerage account.
A lot of military pay is untaxed, right? Like basic allowance for housing, basic allowance for sustenance. If you happen to be deployed to a combat zone that's eligible for combat zone tax exclusion, there's a lot of tax benefits in the military. And so you can keep compounding on that by using tax advantage accounts, tax advantage retirement accounts. So, we like to talk about the Roth TSP and the Roth IRA, two separate accounts. Go search the podcast. We have episodes all about that. We're not going to get into it on this one, but you can also look at, this is another topic to dive, if you want to dive into, is asset allocation location. That's a mouthful, but, or just asset location. And the Bogleheads have a whole website set up about this where you can, basically it tells you like, look, if you have, a high flying stock, maybe that should be held in your Roth account because you're not going to pay any capital gains tax on that. And if you have a index fund, a bond index fund that's throwing off a lot of interest and dividends, maybe keep that in a retirement account, like a traditional retirement account, so that you don't have to worry about paying tax on that as you grow your net worth. So yeah, number 8, minimize taxes. The nice thing is in the military is we don't have to worry about taxes as much as some career fields, but part of that is just because our pay is so low. So that's not a great problem to have. You want to worry about taxes, right? You not worry about them, but you want to, the more concerned you are about them, really the more successful you are. All right, number 9, invest with simplicity. Back to LADS, low cost, automated, diversified, and simple. Keep it simple, stupid. The more complicated something is, the more likely it is to break. A simple 3-fund portfolio or even a single low-cost index fund ETF is going to outperform most active managers over long periods of time. Warren Buffett once bet a group of hedge fund managers that over a 10-year time period, net of fees, the S&P 500 would index fund, an ETF, would beat the hedge fund manager's average return. And it wasn't even a contest. After like the first 2 years, the S&P 500 was so far ahead. So there was 5 different funds or hedge funds, and average annual gain, the highest one was 6.5%. Annualized. The S&P 500 did 8.5%. The final gain over the whole time period, the best fund gained 87%. The best hedge fund gained 87% over the 10 years. The S&P 500 did 125%. So imagine being a multimillionaire or billionaire and you're investing in these hedge funds that are charging you 2% plus 2% asset under management fee plus 20% of profits. And after 10 years, you would be twice as rich if you just dumped it into an S&P 500 index fund like the C fund. I mean, it's almost comical how bad these hedge funds are at making anybody money but themselves.
Well, when you make it really confusing and complex, then people have to hire someone. And I think for a lot of them, that's the point of it is you wouldn't understand this. You're just a military person, or you're not rich. You're not wealthy enough. You're too middle class to understand how to invest. So the Boglehead philosophy takes that power back from the hedge fund managers, if you will. And then number 10, we encourage you, stay the course. This gets back to the workable plan. Your success is long-term, decades, not months, not days, just a couple of weeks ago, I had a family, like someone called them, hey, it's not doing great. The thing's down. And then I was like, for what period? And they were looking at like the week. It was down like 2.7% for the week. I'm like, well, zoom out a little bit. What's it doing for the month? Okay, it's down. What's it doing for 3 months, 6 months, year to date? It's been up 12% or whatever. I can't remember the specific numbers of that fund that they were in. But it's like you can't measure your performance for investing as a military family or any Boglehead investor in days or hours. And a lot of times when you're on the Robinhood app with your friends at the unit, that's what they're doing. They're looking at hourly updates. We're talking about decades of growth for your finances.
I've seen this in my own life, Jamie, where my wife and I came up with a plan, which was basically live on less than we earn and save and invest the difference. And we stuck to it for over a decade. And, the first $100,000 took us over 4 years. And then the second took us 2 years. And then it just kept going from there. And when you have a plan and you stick to, I mean, there were so many stock market drops during that time period. There were so many boom markets, bust markets, but it all just washes out over long periods of time. And I saw something the other day talking about how they're not confident that the S&P 500 will return its average return over the next 10 years. And I said, based on what? Like, do you think that there's going to be another Great Depression? Do you think, and if your crystal ball is this good, please let me know. But no, they had no evidence. They had no thesis. It was just a gut feeling. Go back, look at the historical record. Look at how the U.S. stock market's performed over the last 100 years and think about all the historical events that happened during those periods of time. Even recently, Jamie, and it's so easy to forget now that the market's back at an all-time high, right? April of this year, not even a year ago, I remember you and me texting each other back and forth being like, hey, the market's down 19%. Like, what are you thinking about doing? What are you thinking about doing? And you and I have been through worse crashes than that. Like the COVID crash was only in the last 5 years. But it's scary when it's happening, and it's never happening in a bubble, right? It's never happening in an isolated incident where, okay, only the U.S. market's down 19%. No, there was trade wars, and there was actual wars, and there was political turmoil, and there might be riots in the street. I mean, there's like always something. There's always a reason to sell, right? And there's always a stock market crash coming. It's how do you prepare yourself for it, and how do you build an investing philosophy, an investing plan, developing a workable plan that you can stick through good times and bad. And I think the Bogleheads gives you that framework. It gives you that DIY, that do-it-yourself approach. And military service members are resourceful and, get it done types of people. That's just, the types of people that we recruit and that we get through training as people who can solve problems and can learn new skills. This is a skill. It's actually incredibly easy to learn. You can pick up my book, Military Money Manual. I'll walk you through it in like 2 to 3 hours. It's free at the MWR library, Libby, the library on base. Go pick it up or get it on Amazon. It's like $3 on Kindle. I'm basically giving the thing away. I want you to read it. And a lot of the ideas in the book came from the Bogleheads investing philosophy. And I'm glad we got to run through them today, Jamie, the 10 steps.
Thanks so much for tuning in to this episode of the Military Money Manual podcast. If you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This helps others find the show, and we really appreciate it. Thanks again for tuning in, and we'll catch you in the next episode.
The views and opinions presented here are those of the speakers and do not necessarily represent the views of the DoD or its components. Reference to any commercial products or services does not constitute DoD endorsement of those products or services.